So yeah, I think given that we saw, such a positive surprise from the ADP, I think we were somewhat ready for this report as well coming out for today. But overall, the market really has been shrugging off a lot of these job reports. It really hasn't been as focused. I think we understand that still a lot of people are going to be filing or continue to file, that there's a definite delay in actual reporting. And so I don't see this being as big of a mover for today as just more of the sentiment around the reopening of the economy.
So, Erin, do you think that today's nice big rally is the market just getting ahead of itself a little bit? Are we being too enthusiastic here? Because when you look at fresher economic data like continuing jobless claims, they actually rose in the latest week. We still have 22 million people, drawing unemployment claims in this country. So we're still in a pretty deep hole, wouldn't you say?
Yeah, I mean, when we're looking at overall unemployment and looking at just economic data, that's a little more lagged. But certainly, like when you look at the overall expectations of where we're going to come into the recovery and how long this is going to take, we're looking at 12 to 24 months. I see this rally early just for the today, then this morning, coming off of somewhat of a slightly negative day. The growth stocks really got hit. Value really was the better of the outperformer yesterday, and so it's not unexpected that we'd see a bit of a bounce back after yesterday's action. So I'm not so sure that this is going to be necessarily continue. That we'll be saying this by the end of the day. There might be a little more of a subdued nature. But again, we knew it was going to be positive just because the previous ADP report. So I think, you have to take all of these reports with a grain of salt because we know that the numbers are changing so quickly. There's so much volatility and there's just issues with actually reporting and people actually reporting, jobs and unemployment numbers.
And again, worth noting, we're still waiting for President Trump to give a press conference following the surprising jobs report. Erin, what specific stocks do you like off a report like this?
So I've been really focused on balance sheet and strong cash flow as well as credit worthiness, high quality stocks, particularly as we've seen just a slew of bankruptcies come out. And I think this is just the beginning. Again, we're looking at like a 12 to 24 month recovery. So you've got to be able to have a good, strong balance sheet to be able to withstand retracted and prolonged retracted business activity. And so some of the stocks I like are the cloud services, software services, so F5 Networks, Microsoft, IBM. I also like a few specialty retailers that particularly do well during recessionary periods. And so Home Depot, Lowe's, Sherwin-Williams, all of those sort of home improvement stocks, they've often done well, particularly as you're confined. We're also seeing a lot of people move out of cities and try to move into new homes. We're actually seeing, good new construction builds. And so again, these are the types of stocks that would do well, whether you're either buying a new home, moving out of those cities, or if we're still very much focused on staying at home a lot more, and you might want to, put a new coat of paint on those four walls that you have to look at so much longer.
Yeah, that sounds good. A little refresher in the home, Erin. I hear you. What do you make of those stocks that have been beaten down the most during this pandemic, namely the travel stocks, hotel and airline stocks, cruise liners, which are actually doing quite well today, as Jared pointed out earlier, as people sort of take advantage of those rock bottom prices in some areas. But are you invested in those sectors, and are you bullish on them?
Yeah, I think those, for me, they're very short-term trading. And we saw a bit of a pop with the airlines yesterday as well. So for me, I think those are the industries where we know there's going to be consolidation. It's very unlikely that when we come out of this, 2 years later, that we're going to have the same number of airlines and just as many hotels. You're really not sure who's going to be able to avoid bankruptcy, or if we're going to see just more consolidation and avoidance. We also know that business travel is very likely going to be hit. We've all gotten used to be able to doing video conferencing. We've all become very adept at whether it's Zoom or WebEx or your Google, Microsoft Meets. And so that was one of the major profit centers for a lot of these travel, both hotel and airlines. And I see that as being a long-term secular trend of less business travel. And so I really feel that given that you're looking at an industry that could be continuing to see a decline even as the economy recovers, this isn't an area that I necessarily want to be invested in. And that's why I'm more focused on software technology, cloud services, as we move more and more into that space, and this being a longer term trend.
Erin, when you talk to clients, and Alexis mentioned this earlier, do you sense irrational exuberance starting to form? Are people starting to just foam at the mouth? Like, I want to get in this market and I'm getting concerned I'm missing out.
I actually, my clients are saying, I can't believe this market is so high. So I don't see a lot of people missing out or being concerned that they aren't invested. Most of my clients stayed invested and didn't take out, or if they did take out, they took out in March and they're very comfortable with that. I think what we're really most of, large money managers are really concerned that we're looking at such extraordinary valuations, and the market really isn't moving off of fundamentals. We're moving off of sentiment around, case numbers, by how whether we're reopening economy, vaccines. So it really, basic economic numbers. So, the jobs report certainly has a short-term effect, but for the very most, it's really sentiment about the virus and opening up the economy rather than looking at fundamentals. And part of that is we're just so hard to predict what's going to happen. It's such a volatile and unprecedented and unpredictable environment. And so it does make me a little concerned that it'd be very hard to sustain these types of levels when we're looking at such a, again, definitely a recession coming ahead and a global recession. And it is a bit concerning about some of these levels on some of these stocks.
Erin, what kind of clues are you seeing the Treasury market sending us? The 10-year Treasury yield pushing above 0.8% now. Bond market seems to be breaking out of its doldrums. What does that tell you about investor sentiment right now?
Well, part of it, we knew we had a lot of cash on the sidelines. I think maybe people are a little more willing to perhaps move into equities. They aren't as conservative or as risk averse. I think, again, with the stories around, particularly once we really started seeing more and more stories around cities reopening, I think that has really, again, we had 4 days of an up market in the S&P 500. And so then you're seeing the bond prices come down. So I think it's just more, again, it's a sentiment. People are more confident, a little less risk averse, but it's really more about day-to-day life rather than actual fundamentals.
All right, we'll leave it there. Erin Gibbs, President of Gibbs Wealth Management. Always good to see you. Have a great weekend.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.